interest rates. There's something big happening this week, and good deals are starting to pop up. All this and more with our good friend and mortgage broker, Mr. Dion Beg. Hello, my friends. Here we are back again with one of our favorite, not one of, our favorite mortgage broker, Mr. Dion Beg. How you doing, my man?
I'm good, man. I'm good. I've been traveling with the kids, so I'm in a different location today, but excited to be here.
Excellent, excellent. This is what we love about summer, right? All seeing people, seeing friends and family we haven't seen for a while, and moving around and checking out what's going on in any local market that we're in. I can't help myself. I don't know about you. When you travel, do you pull up, the local real estate info?
Yeah, I do, and I drive around neighborhoods. I drive around neighborhoods I own property in to see what is up for sale and how many open houses there are. I was actually expecting more for sales in some of the areas that I drive around in, and I was surprised to see, actually, yeah, not too many. I was expecting more based on what I've been seeing and reading in the media, but it doesn't seem to be that. And I've been driving around mostly Durham, East and Toronto area.
Yeah, yeah. I'm the same. I go to a new area or I go visit one of my rental properties and I drive. You got to drive in neighborhoods. You got to know what's going on around these areas. Okay, so this video is going to be kind of a summary over the last couple of months, in a sense, in the fact that many of you have asked questions or comments or sent both Dean and I direct messages and looking for clarity on some stuff, or just kind of where the market's going over the next 2, 3, 4, 6 months, and we're going to answer some of those questions. And one of the questions that's come up, Dion, that was probably quite popular 10 plus, even 20 years ago, and even more popular in the States, is cashback mortgages. Sorry, cashback sales. I'm not talking about the mortgages because that's an actual product. When we can certainly talk about that, but cashback from the seller. And we would do things like this in the past where, even 10 years ago, where we were buying an investment property and it needed work because it had deferred maintenance or what have you. And we would ask for, we'll use an example of $10,000 cash back from the seller so we could go repair the roof or what have you. My question today, though, as mortgages have changed drastically, how do the lenders look at that type of situation?
Yeah, so if every now and then we'll get a contract for a purchase, and I'll give you a simple example. Purchase price of $500,000. They do the building inspection, and then they realize that okay, the roof is going to need a replacement. Okay, and what they could do is they could just drop the price by say 10 grand and say, look, let's pay 490 for the property. But sometimes they say, well, you know what? No, let's transact this deal at a $500,000 purchase price. But we'll put a stipulation in the contract that says at the time of closing, the seller will give back to the new buyer $10,000. Okay. And so on the face of it, you go, okay, that makes sense. The buyer is going to get back their 10 grand and then they can fix the roof at the time. The problem there, though, is that the reality is it's almost the same as a $10,000 price reduction, right? So the way that lenders in Canada will look at that type of a clause in a purchase agreement is that they'll say, okay, we see what's going on here, but this means that the lender is going to treat that transaction at a $490,000 transaction price, right? So you think you're getting a loan for 80% of 500 grand, you're actually only going to get a loan for 80% of $490,000. So that's the way things work in Canada. I know it's very different in the United States. It always has been, where there's a lot of cashbacks from the seller at the time of closing. And I can understand the more conservative Canadian perspective, which is, you know what, we're actually funding more than the property's worth on the day of closing, right? Because without that roof being fixed on the day of closing, the property's not worth 500, it's worth 490. And so, some people say, well, this is a little bit too conservative. But again, this is why the Canadian real estate market has always been a bit more protected in downturns, because we are a little bit more vigilant and stringent around, little issues like this.
Yeah, and we'll see this, and I think I mentioned this off the top there. We'll see this in commercial transactions on in larger, much larger buildings. As you were talking there, I had a thought come across is, there might be some people out there that would suggest, well, just do an amendment and don't send that amendment into the lender and they'll never see it. Trust me, my friends, that is not the right way to conduct your business. And you might say, well, the lawyer will just move things through. Dion, when you transact on a property and you're obtaining a mortgage, who does the lawyer represent in that case?
So the lawyer has to equally represent the borrower and the lender. And so if they come across information where, hey, there's a price reduction that has not been communicated to the lender, they must legally disclose that to the lender. And so you're right, Gary, there may be people who think there's ways around this, but no. I mean, things are set up in such a way to protect the both the lender, but also just the integrity of the real estate market, right? Because who's to say, oh, well, somebody's not getting back 200 grand at the time of closing, and overinflating a purchase price, right? So these are things that we have to be very careful with.
Yeah, good stuff. Okay, moving on. A couple of comments have come in, and even I've noticed too, is, I'm reading things, but I just wanted some more clarity on some of this, Dion.
Sure.
And that's the lenders, in a sense, preparing or planning, I should say, on credit loss prevention and things like that. Help us understand what the banks or how the banks are positioning themselves when it comes to that.
Yeah, so this is going to sound strange, but historically, it's only when rates start to drop that defaults start to increase dramatically. And on the face of that, you go, that doesn't make any sense. If rates are dropping, then defaults should be decreasing. But when does the Bank of Canada drop rates? It's only because they feel like they've made enough economic impact for people to feel pain, to say, okay, you know what, we're going to take the pain off a little bit, right? We're going to drop rates. But again, they've done so much in the negative to hurt people through increasing interest rates that for the first 18 months of this rate hike that we've experienced, it was nearly 24 months actually by the time they actually turned the dial and said, okay, let's start going the other way. It's only then that the consumers out there have been living off their savings, trying to transfer credit cards balances across, and they've just done every sort of trick in the book to stay afloat, right? But they finally reach a point where they've run out. They've run out of time. They've run out of money. And now they're going, okay, well, we can't make the payment on that credit card. And, the car payments start to slip. And finally, mortgage defaults do start to increase. So we have noticed a small increase in mortgage defaults, even though rates have dropped. And it's because the rate drops that just happened won't actually be really felt inside households for several more months. Whereas what people are feeling inside households right now are due to the rate increases that we experienced, 12 months ago. So we're in this really weird stage where, things are getting better, but the damage is already done, right? And so we're going to probably see a little bit more pain, even though interest rates are dropping. And this is again why banks have been putting aside more, I guess, insurances for these credit defaults.
Gotcha. And to kind of expand on that a little bit is, if you were signing a new mortgage in the last 2 years or so, you were definitely increasing your interest rate payments. That's kind of a given. And a lot of those people have, perhaps they're in a locked in mortgage. So even though the interest rates are coming down, their rates aren't coming down. Just that's kind of what it is. Dan, for those that are perhaps, and maybe the timing isn't quite just there yet, as the interest rates are, we've been told they're coming down, and we'll talk about that in just a minute. But maybe in a year from now, they're down a whole full percent or even more. And if you're locked in at something that's higher, should they be reaching out to you to explore perhaps refinancing and getting a new mortgage and looking at the pros and cons of that?
This is a great question, because I think if anybody renewed their mortgage in the last 24 months, they were renewing at a time when they did not know for how long interest rates would continue to increase. And so many people, just for the peace of mind that it would give them, took a 5-year fixed rate. Now, they might have taken that 5-year fixed rate close to 6%. But you're right, in about a year from now, I would imagine those 5-year fixed rates might be closer to 4%.
Mm.
Okay. And they'll be in the situation where they go, oh, damn, what should I do? Should I break that mortgage and then transition over to this newer, lower rate? And the answer is it'll depend case by case on what those specific penalties would be to break those mortgages. The reality is it's oftentimes more expensive to break a mortgage and go into that cheaper rate than it would be to to change, get that cheaper rate, but that penalty sort of outweighs the benefit of actually moving lenders or getting that lower product. So certainly we run those numbers on a case by case basis, and in most cases, the penalty is going to be more painful than the benefit of a lower
Gotcha.
rate.
Gotcha.
Yeah.
You would agree, though, that it's important to ask that question or to ask those questions along the way as interest rates are, are changing. We're told they're going to be changing. So if you're not asking those
Yes.
questions, you should
And
be, because you never know. You could be saving yourself thousands of dollars, or that monthly payment could be reduced by $400 or $500 a month, and that's a lot of money for a lot of people, right?
correct, correct. I mean, I can tell you that I could probably count on one hand how many people we put into 5-year fixed rates in the
Mm.
last year or so, and that's because as much as people approach us with that mindset where they are quite scared, they were quite scared of what was happening in the economy. We said, okay, we understand why you want a 5-year fixed. Here are the costs associated with it and the challenges associated with it, and maybe consider a 3-year fixed or a variable or a 1-year or what it might be. The majority of people, once they reason it through, did take those shorter terms. But I can imagine there's a bunch of people out there who did take that 5-year, and yeah, we would be happy to talk to them about it.
Gotcha. Okay. Interest rates. Rumor has it, in fact, 85% of the people out there that seem to be in the know are suggesting that there's going to be a rate cut. What's happening here? Are we seeing it? Are we going to feel it?
Yeah, so look, the bond traders are the ones who really have their finger on the pulse as to what they believe the market is doing now and where it will be in months from now. And so the reality is that that bond yield is down. And so most people are saying, yes, this next rate announcement on July 24th is going to result in another rate drop. And so I would agree with that. And I've got some stats here, which I wrote down before today's call, which sort of why is this the case? So retail sales are down 0.8% month over month. Okay, unemployment is up at 6.4%, almost up a full percent from last year this time. Inflation in June was down by 0.2, and a really interesting number in there, Gary, is the shelter cost. Okay, shelter cost year over year in terms of mortgage interest payments is up 22%. Okay, so if you're the average Canadian out there is experiencing a 22% increase in their mortgage interest over 1 year, um, and that's not going to be the case moving forward because the next moves to the Bank of Canada are not up; they're either flat or down. Okay, um, and and the other thing I want to mention here, is sort of anecdotally, is a lot of people, the headlines out there are talking about the pain that renters are feeling, right? Oh, rents are up significantly and all these poor renters rates are up. And I totally empathize. But proportionately, whereas mortgage interest costs are up 22%, rents costs are up 8%. And so it's in fact the homeowner who has that mortgage who is in fact feeling a little bit more pain than the renter, even though the media paints a picture where it's somewhat the opposite, and the landlord who happens to have a mortgage is the bad guy. But just keep in mind the landlord's costs went up 22%, whereas the renter's costs went up 8 on average. Right. Okay, let me just continue on with these stats. GDP growth. Oh, actually, have we talked about a soft landing terminology before, Gary?
No. So I know, there's a lot of buzzwords out there, and soft landing is definitely one of them, my friends. And that can mean a number of different things, but help us understand it from kind of that mortgage perspective, the real estate and really the economy.
Sure. So a soft landing in terms of economics is when the Bank of Canada tries to slow the economy but doing so without putting it into recession, where we have zero or negative growth and significant unemployment. So if we can avoid those things on the way down, then they will call that a soft landing. And the headlines right now are, look, yeah, Canada's managed to engineer this amazing soft landing. Okay. And that's based on the measurement of GDP, which is positive. And they're saying, the headline GDP is at 1.5%. But RBC came out with their own report, which said that technically 6 out of the last 7 quarters we have had negative growth. We've had contraction in the economy, and that's based on a per capita measurement. Because as much as GDP has grown by 1.5%, population has grown by way more than that number. So per capita, we are technically in a mild recession. Okay, so and I think that, again, anybody who's just your regular Canadian on the street already feels this. They know this, right? No matter how many headlines are put out there to say, oh, we're in a soft landing and we're going to be fine, there's enough people out there that can tell you that, no, they're not doing fine. They're doing pretty damn poorly right now.
Yeah. Well, it affects so many different things. Like, as an example, my daughters both work at a local recreational facility, an attraction right here in the Stouffville area. And the amount of people that are patrons that are coming to visit that establishment this year versus last year, the girls will say it's probably, they exaggerate, but maybe half the amount of people. So there's a lot less of that extra spending money that people are willing to let go at this moment, right?
Right. Yeah. And I think, well, you would imagine that in summertime, an outdoor attraction like the one they work at would be, quite popular. And if what they're saying is that, yeah, people are not spending that money, and it's not expensive. I know there's, it's not like going to Disneyland.
Yeah.
It's less than $100 to go on an adventure or whatever it is. That's surprising. Yeah, especially at this time of year.
Yeah, exactly. Okay, so kind of carrying on in a sense, I'm looking for a segue here. It's not happening. However, so this is what we're going to talk about is the number of listings. We all know they're up versus this time in last year, or versus this week versus 2 weeks ago or 4 weeks ago, and that's just the nature of what's happening in our market right now. You had sent me something that came up for sale, and the valuation looked, we'll call it low compared to what maybe we've been trained to see, right? Is that kind of...
Yeah, that's right. So, I mean, in my position, I get to see multiple transactions from every corner of not just Ontario, but also across the nation. And so when I come across a deal like the one my client just purchased, it always makes me raise an eyebrow. So this is a freehold property in Parkdale, downtown Toronto. The transaction price was just over $1.1 million. And it has, three plus one bed upstairs, and it's got a self-contained basement apartment with, another bedroom, bathroom. So it's a rentable apartment. And at 1.1 million, it made me stop and say to myself, wow, this property likely 2 to 3 years ago would have been up around the $1.5 million mark. And, actually what's really interesting also on this particular deal, Gary, is this is a client of mine who's moving into Toronto from Alberta, which is the exact opposite narrative that you're seeing in the media again. And look, I know that this is anecdotal, and I know probably on a mass scale, we have more outflows to Alberta than into the GTA. But again, it was interesting to see that amazing transaction price and a person coming into the country, into the province.
Yeah. Sometimes we think Ontario is its own country. Okay. Right. Well, and that's the interesting thing too here. And I did a little homework on that individual property, and you and I were both curious in a sense. Okay, is this did they sell and did they just purchase the home a couple of years ago? Were they looking to exit as something that perhaps they overpaid for in the grand scheme of things? And no, they had owned this property for 10 plus years. And we're seeing a lot of that. And in fact, you and I even took that a step further and like, well, Garrett, like what happens when we pull just a random 10 properties in the Stouffville area, somewhat of an, I'll use the word affluent in a very cautious manner, but the homes, our valuations are about 1.3 average price. And I pulled 10 random listings to see when they were purchased by the current sellers. And there was only one out of those 10 that were purchased in 2022, where you could argue is about the height of the market.
Yeah, yeah,
Everything else was, 15, 13, 2010, 09.
right.
They'd all
So we're
owned them
talking
for
like
10 plus years.
7 to 10 to 15 years of ownership. And so out of those 10, one of them may be selling because of the large mortgage they took on in 2022 that they can't potentially manage anymore. But it would be fair to say that the majority of the others probably aren't selling with that sort of heavy mortgage load, right?
Yeah. And
Mm.
and it's probably fair to say, now we didn't go deep on those other 9 listings, but fair to say, you typically own a home 7 to 10 years, and that's kind of the time frame that it comes up because you either
Mhm.
outgrow or job moves or life changes, and about every 7 to 10 years, and that's what we're seeing here. We're not naive. Trust me, Dion. You and I are not naive to the fact that people do need to sell for obviously financial reasons, and that will certainly lie there within the cracks. But just 10 random listings, people are moving their equity to another home just based on what we're seeing there in the market, right?
Probably just, yeah, family needs, life events, whatever it might be. People just need to sell. When they need to sell, might need to move to Kelowna to live a amazing life in the mountains and the lakes, like yourself.
That's right.
But yeah, actually, Gary, when I was looking at some stats around this and trying to figure out, okay, what's the extent of the mortgage load, I came across an interesting stat from Equifax, and I'm gonna
Okay.
I'm gonna ask you this question, and Equifax published what the average Canadian mortgage balance is, right? Now, before I get to that, let me give you some other stats, and I'm going to ask you what you think that is. And I got it wrong, so I was super surprised by what this number is. But statistically, in Canada, there are 15 million households, a little bit over 15 million households. Okay, 67% of those are owned and 33% of those households are renters. So that's the proportion. Okay. Now the 67% that are owned, about half of them have a mortgage. All
Okay.
right. About half of them have a mortgage. So that's 30, 33, 35% of Canadians have a mortgage. All right. So now the question would be, what is the average balance on those mortgages? What do you think that number might be, Gary?
Average balance on, I'm guessing there's about 5.5 million homes or mortgages of that. I'm just kind of using your
Yeah,
numbers there.
somewhere in that range. Yeah. Yep.
Okay. So the average balance on that, geez, knowing the populations in Vancouver, Toronto
Yep.
area, I'm going to be wrong, but I'm going to go something. I think it's low. I'm going to just go at $200,000.
You're pretty close. I was
Oh, for
way
real?
much higher than that, right? So the number is 261,000. Okay.
Really?
And for anybody who's listening who's like a new home buyer or bought in the last couple of years, you're saying, you guys are crazy. What do you mean? My mortgage is at 500 grand, 800 grand, 1.5 million, depending on where you're at. But just keep in mind that we're talking about everybody who has a
Yeah.
mortgage, including your grandparents, maybe, who bought a property many, many years ago and still have a balance on it of maybe 20 grand. Okay. So I will say that, as I'm arranging mortgages, the majority of the mortgages that I'm arranging are well over 500 grand in today's market. And so, 261 is the average national amount. But it's going to be skewed. The people who are going to be impacted by these interest rate changes are the people who generally have purchased or refinanced more recently, and have that top heavy load on their mortgage balance. But another interesting stat there, and as it relates to this proportion, is 40% of the homeowners are baby boomers, right? And again, just based on that, it means that the majority of those people in that 40% of home ownership, they got their mortgages a long, long time ago. So they're not going to be impacted in the same way that their children are being impacted by these interest rates because they just carry a lot less debt.
Yeah. Yeah. I'd be curious to know how that's changed, that average balance, how that's changed over the last, 5, 10, 15 years. And then looking forward, it's bound to increase because those baby boomers are going to let go of their properties. There's going to be a tremendous amount of equity. We keep talking about that passive, not passive, that
Transition.
movement of wealth transition. That's the word of wealth over the next, starting a couple of years ago and moving forward probably for the next 20 years in a sense, right? Because those baby boomers in a sense are, 70 years old to 80 years old, and people we've talked about this, people are living a lot longer, right? So that
Correct.
generational wealth will take a little bit longer to pass on. Interesting
Yeah,
stuff.
most
Yeah.
definitely.
Yeah. Good stuff, my friend. This has always been I like when we do calls like this because it kind of takes a part of what people are asking, what we're seeing online, kind of those questions that are coming up, and we just kind of peel that onion in a way, and this is what is on people's minds. You've had, in a sense, you had a live deal in front of us, and we were talking about that and how there's opportunities out there in the market. So if you're looking for a home with rental income, there's lots of properties like that or lots of opportunities. So talk to Dion and myself. We're happy to guide you in the right way. Dion, how do people get a hold of you?
Yeah, at kangamortgage.ca or Instagram at the Dion Beg.
The Dion Beg right over there. I'm Gary McGowan. We'll see everybody in the next episode. Goodbye for now.